There is a good reason to be concerned. Risk on assets are at extremely high prices. Stocks and crypto, they tend to be at all-time highs, and the problem is that this could lead to a crash. People are now buying into gold just to hedge against the potential crash. Now there are two camps. There is a camp that says don't try to time the market. Time in the market beats timing the market. But there's the other camp, myself included, that does get worried when the historical PE ratio is at close to 40. This is a very long-term chart. It starts in 1871. And so now when we buy an average stock in the S&P 500, we are paying 40 times its annual earnings. And that's not just a random indicator, because what we are buying with stocks is indeed the future earnings. So stocks are objectively expensive. But then there's also the traditional camp, and I can understand the arguments, but I tend to disagree. The traditional camp says that over the long term, prices go up. Imagine you were so scared at the peak of the dot-com bubble that you sold all your stocks. So the beginning of the year 2000. Here's the S&P 500. Since then, it actually still went up. If your time horizon is long enough, you would have made 340% since then. Now here's the problem with that argument. Dollars in the year 2000 are not worth the same as today. And so when we look at the S&P 500 relative to the money supply, the gains look very different. The monetary base in the US, USM2, increases by 6.8% per annum. This is a linear chart. Here's the same on a logarithmic chart. So really the growth is kind of predictable. Sometimes you grow a bit quicker, sometimes a bit slower, but really 6.8% is the benchmark. If you make less than 6.8% per year, we are losing purchasing power with our investment. And so this is the S&P 500 relative to the money supply. The year 2000, that's over here in this chart. So had you bought at the peak of the dot-com bubble, you would have made no money at all relative to monetary debasement. And so it's true that it's a bad idea to time the market in a way that we sell our equity just for cash. Because cash devalues that quickly. But that doesn't necessarily mean that just because stocks are better than just holding cash, that it's the best option. Again, in purchasing power, if there was no debasement of the money supply, you could have lost temporarily 73%. And temporarily here means 10 years. Had you bought something else during that time, so let's say gold or silver or T-bills, you would have done much better. It doesn't look that bad on a US dollar denominated chart, but again, the US dollar is an extremely bad denomination. If something is rotting away by 6.8% every single year, it doesn't make sense to look at long-term data in that unit of account. We can also slightly change that chart, right? This is now the S&P 500 relative to the gold price. Again, not necessarily that inviting. Had you bought stocks at the peak of the dot-com bubble, you would have lost versus gold by 89%. Even more than versus the money supply, because people are buying gold during uncertain time. And who am I to make price predictions? But if I look at this chart, I think this seems to be more likely than this. And so really, where does crypto sit in all of this? If suddenly equities come down, if the S&P 500 crashes, if the Nasdaq 100 crashes even more because of the AI bubble, if maybe then afterwards there are also doubts around the solvency of the USA, because maybe the US dollar isn't really that much of a reserve currency anymore, because the central banks are buying gold. If all of this happens, then where will Bitcoin be? Will Bitcoin react like another digital gold? Or will Bitcoin react like another risk-on asset? I think the second is more likely. This is Bitcoin on a very long-term chart, and for whatever reason, the tops align quite nicely on this curved line. And it shows that there's maybe not that much more upside potential, but there's definitely more downside, because connect the bottoms in this manner, we could potentially go down by 60% from here. And again, this is all happening without even any big crisis. This is where Bitcoin got created. This is again the S&P 500 relative to the money supply. So since Bitcoin's existence, we have only seen risk-on assets appreciate. We've never really seen a real crash in risk-on prices. This is the Nasdaq 100 relative to the S&P 500. So how are tech stocks doing relative to the rest of the stock market? This was the dot-com bubble crash, and Bitcoin was created over here. So again, there was only expansion since Bitcoin's existence. And we can barely see the COVID crash here even. The problem really is that nobody wants to hold US dollars long term anymore. The central banks are buying up all of the gold. That's why the gold price relative to the monetary base is that high now. It could potentially go up even higher, but various entities are preparing for the big collapse. This is the year-over-year reserve change by region. So how are the central banks buying into gold? It's roughly 500 tons every month or 6,000 tons per year, which is 3% of the entire gold supply every single year. And half of the supply of gold is just jewelry, right? It's not that price sensitive. On top of that, we've also got the purchases through the ETFs, which is also roughly 500 tons every single month. So both of those entities combined buy 6% of the entire gold supply every year. Some people are prepping for the worst case, myself included. I don't want to live through a crash to then, after 10-20 years, get my money back in devalued US dollars. Now, besides gold, there's also silver, and there is a high correlation between the two. So when gold is going up, silver tends to go up when gold is going down. And so with the recent gold rally, silver can also profit. Here is silver relative to the money supply. The dotted line is the average price. This is again a long-term chart starting in 1959. We are close to the historical average, but long-term, silver might underperform as a store of value, simply because too much new silver gets mined every year. Here's the silver to gold ratio, again the same development. If something expands quicker in supply, it tends to also underperform over the very long term. But of course, within this trading range, we might be somewhat low. There's more upside for silver than for gold, but there's also much more risk for silver than for gold. If everything crashes, then silver will come with it, at least temporary, because silver is also an industrial metal. So if there is a big depression in the overall economy and there's less manufacturing, then silver will also get less demand. And silver is heavily used, for example, in the auto industry for electric vehicles. And when the economy is shrinking and everybody is unemployed, nobody buys new electric cars. The car industry is very sensitive to economic cycles. The silver market cap is slightly larger than the Bitcoin market cap. But again, I think the best in this situation is to have at least 5, maybe 10, maybe even 20% of a portfolio in risk of assets, in assets that outperform in case the world delevers again. Have a look at those two crashes. So this is the COVID crash and this is the correction in 2022, where Bitcoin went from 72K all the way down to 16K. Let's compare those periods with different assets. This is the S&P 500, so it crashed in a very similar manner. In other words, the S&P 500 is a very bad diversifier against the crypto holdings. It does not make sense to protect a portfolio by buying stocks, because both asset classes move in similar directions at the same time. Over here, we've got gold during the same time period. Gold appreciated during the COVID crash, and it at least kept its purchasing power, while Bitcoin went down by 70%. And over here, we've got silver. Silver crashed together during the COVID crash. As said, it's also partially a risk-on asset. And while it didn't go down as much as stocks or as Bitcoin during this correction, it also didn't make any money. So again, silver is still partially a risk-on play. It might be comparatively cheap to gold, but it's not as good of a hedge in times of crisis. In times we really see suddenly the AI bubble pop or the US debt bubble pop. Now, most people try to beat the market by reading the news or by following the narrative of the day, but I don't think that that's a good approach long term. Most people just follow their gut. I think it's better to use statistical data analysis. Try to figure out what kind of rules worked in the past that might continue to work in the future. So you might know about this. I have back-tested moving averages for Bitcoin to try to find out when are we bullish, when are we bearish. It's a trend following strategy. We buy whenever we are above the moving average. We sell whenever we are below the moving average. Now I've back-tested all moving averages from the 2-day all the way to the 200-day. And the 125-day simple moving average and the 44-day simple moving average are the ones that historically work the best. That's the two moving averages we see plotted over here. So the 125-day is the line in turquoise, the 44-day is the line in orange. Now have a look at the historical performance versus buying and holding Bitcoin. So we are betting on rising prices whenever we are above. We're betting on falling prices whenever we are below. This is the 125-day. Buying and holding Bitcoin would have given us this performance here in white, but the backtest gave us the performance in turquoise. Here's the same for the 44-day simple moving average. We can see, first of all, that we outperform long term, but also that our volatility is lower, as in the drop from top to bottom is less compared to buying and holding Bitcoin over the same time period. Now, when we've got an approach that tends to perform more and still is less volatile, still drops less compared to just buying and holding Bitcoin, why don't we lever this up? So I tried to find the optimal leverage. If you go long, the best leverage is 2.75. If you go short, the best leverage is just 1x. If you have the same leverage for both directions, long and short, then 2.25 is the best. But in general, I think it's better to have different leverages to go harder on the long than on the short. So this is the 125-day simple moving average. If we only go long, we never go short. So whenever we are below the moving average, we're just in cash, we're just going sideways. And here is the short side. So we never bet on rising prices of Bitcoin at all. We're only betting on falling prices. And of course that underperforms buying and holding Bitcoin. But still, it shows us that even though in a long-term appreciating asset, if you can only bet on falling prices, we can still make some return. And so let's say we use the 44-day simple moving average, but we don't just have 1x leverage. So that's that. But instead we lever this up with 2.75 on the long side, with 1x on the short side. This is much better than just going 1x. And again, this is a logarithmic scale, right? So each horizontal line here is at 10x from each other. So that's my preferred medium-term approach for Bitcoin. I just look at where is the price currently relative to those moving averages, and then I position myself in the long or short direction. And because this might be cumbersome, this might be complicated for a few people to always enter and exit those trades, I've also opened up a capital trading pool for the premium members. They can simply just deposit capital and then I will execute that exact strategy and I won't deviate from that strategy. So if history is any indication, we might get performance that looks similar to that over time. At least that's the idea. We don't want to just follow the news or act based on gut fear. We just follow rules that historically worked well. This was a very quick rundown, but there's way more details in the tutorial section of Premium. The link is down below. It's bitcointrader.com. But I'm also sharing my personal view on the market regularly. So every 3 to 4 days, I publish a Premium update video where I share what kind of trades I open, where I share what kind of positions I take. There are more details regarding the strategy in Premium. They're dedicated videos for that. There are also dedicated videos that explain how to actually run the backtest, how to make those backtests yourself, if you want to do this maybe for Ethereum or for any other crypto asset. And so here is the Bitcoin strategy moving average vault. So that's the trading pool. You just deposit some money into that pool and then I will execute those trades automatically for you. So feel free to check it out. It's currently $125 per month. There's also a 1-week money back guarantee. So in case you do not like Premium, just message me within 1 week and I will refund you 100%, no questions asked. A link to Premium pops up directly here on the screen. Just click on that. It will lead you to the website. If it's your very first time here, feel free to subscribe. I publish these regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in Premium. Cheers.